What is going on, guys? Nick here, back with another video. Tesla has probably been one of the most talked about stocks anywhere that I've seen over the past year. Elon finally hit his goal of 500,000 cars sold in a year, and the stock is sitting right around all-time highs at $800 billion. I thought I would take a look at the business and see what they've done to grow to 20 times Ford's value. How well are they really doing right now financially? And if the stock is worth buying now, what can I expect to get out of it long term? Well, Tesla was founded in 2003 by two guys named Martin Eberhard and Mark Tarpenning, who were inspired after GM recalled its all-electric EV1 in 2003. The goal was to build a technology company with the core technologies as the battery, computer software, and the motor. Elon Musk came on early as an investor in the business. 5 years after Tesla's founding, the company was facing a potential bankruptcy during the financial crisis. Elon ended up loaning $40 million and personally invested an additional $40 million. He ended up becoming the CEO the same year. The first Tesla vehicle was the Tesla Roadster. Their goal was to start with a premium sports car and then move to more mainstream vehicles, like sedans and compact cars. Since then, they've released the Model S, a premium sedan, in 2012, the Model 3, an affordable sedan, in 2017, the Model X, a premium SUV, in 2015, and the Model Y, which is a crossover, in 2020. They also have plans for a Cybertruck, a Tesla Semi, and a new Tesla Roadster. Now, Tesla does some things very different from any other car manufacturer besides selling all-electric vehicles. Tesla has focused on creating vertical integration. Vertical integration is when a company basically maintains control over its production and its sales. What this means for Tesla is they don't outsource components and suppliers like almost every other car manufacturer. Most car manufacturers only really focus on the engine and the final assembly. This allows Tesla to have better control over the design and the quality of their parts. Initially, Tesla really didn't have any other chance than vertical integration because they needed to push innovation as much as possible for their cars like the Roadster and the Model S to work. It's actually how Elon's other well-known company, SpaceX, was eventually able to build rockets much cheaper than any other competitor. Because Tesla designs their own batteries, they're able to optimize it along with the electric motor and all the other components for their exact needs. They don't have any dependence on a supplier's constraints or modification capabilities. One of Tesla's huge advantages in the electric car market is the battery technology themselves. Tesla works with Panasonic in a partnership to make their batteries. Tesla also works with Chinese supplier CATL and South Korea's LG Chem. It's believed that Tesla has proprietary cell chemistry that's different from the cell chemistry these suppliers sell to other automakers. In September of 2020, Tesla held Battery Day, where they released the new tabless battery. These batteries improve on the traditional battery design by offering less internal resistance, so they can recharge faster. They also hold a higher energy density, so these batteries can hold more power per the weight. And because of the larger design, they're actually easier and cheaper to produce. Elon said that he expects battery costs to drop within half over the next 3 years. Now, Tesla's Autopilot to me is one of the most interesting aspects of their business, mostly because I really just want to get in the car and not have to pay any attention to driving. Right now, full Autopilot isn't available yet. It's basically a driver assistance feature that requires you to pay attention still. One thing that's different with Tesla's Autopilot versus other companies is Tesla relies on cameras and radar for their car to determine its surroundings. Other companies like Waymo and Cruise Automation are using LiDAR, radar, ultrasonic sensors, infrared sensors, and cameras. Elon says that anybody who uses LiDAR is doomed because of the extremely high cost. To develop Autopilot, Tesla collects information from sensors in the cars currently driving and uses it to train its software. They're able to send out updates to customers that have slowly improved Autopilot each year. Full self-driving mode is currently an $8,000 add-on when you buy a Tesla. But some have been critical of them using the word autopilot because, well, it's not fully autopilot yet. In Germany, they're actually banned from using autopilot in their advertising because they found it misleading. In 2012, Tesla started building a network of fast-charging supercharger stations. They currently operate 2,000 stations worldwide. The supercharger is a proprietary direct current charger that provides up to 250 kilowatts of power. Tesla superchargers only work on Tesla vehicles, and I think that for Tesla to gain its full potential to getting people to switch from gas-powered vehicles to electric vehicles, they need to continue to make these chargers available everywhere. There are other companies out there who are also building electric chargers like ChargePoint and EVgo. Some of them are teaming up with automotive manufacturers like GM. Now, Tesla actually breaks itself down into two segments, the automotive segment and the energy generation and storage segment. The energy generation and storage segment is made up of the Powerwall, the Power Pack, and solar energy products. The Powerwall is a giant battery that sits on your wall. You charge it during the day with solar panels or from the grid, and then you use it during peak energy hours. Now, the Power Pack is batteries for utilities. These are designed to work with power grids around peak energy usage. One of the major problems energy utilities face is managing demand versus supply throughout the day. They can't just supply the same continuous power all day because it would overload the power grid during times of low demand. But because peak solar energy generation happens at a different time than peak energy demand, utilities can benefit by storing some of this energy in batteries and then using them when peak demand actually occurs. To go with all these battery storage solutions, Tesla purchased SolarCity in 2016 in a $2.6 billion all-stock merger. It's not exactly clear how well this acquisition has been for Tesla. It seems like most of the SolarCity company has been broken up, with many of the employees being laid off, and both of Musk's cousins who founded the company have left. So let's take a look at how well Tesla is actually performing. So looking back at their car sales per year, we see very strong growth. Most recently, between 2019 and 2020, they produced 500,000 cars. Of the 500,000, 442,000 were the Model 3 and the Model Y. During 2020 in the US, Tesla ranked 14th in car sales by brand, just behind Volkswagen and in front of BMW. However, what really sticks out to me is when we look at the year-over-year change. Even with a very tough year for most car brands, Tesla was actually one of the few that saw growth. And not only that, they completely blew away the other growth of any other brand. China is Tesla's largest market. Last year they sold 120,000 cars, but there's actually a lot of local competition catching up to Tesla. NIO, XPeng, and Li combined have come close to catching up to Tesla's monthly sales. And with strong Chinese government support, I don't see this competition declining anytime soon. Tesla has seemed very confident in the Chinese market though, after they've continued to increase production in the Shanghai plant. Right now it's hard to say who will have the majority market share in Tesla in 5 years from now, but Tesla certainly has the early edge. When we look at revenue, operating income, and net income, we can see a growth chart that looks pretty similar to their car sales growth. 2020 was the first full year of profitability for the company. Not surprisingly, the earnings release when they finally became profitable is where the stock price explosion started to occur. Looking at their expenses, we can see the cost of revenue dominates most of their expenses, but this seems like something that I would expect for a company that makes most of its money from selling cars. What stands out as they've grown their revenue from just under $12 billion in 2017 to about $28 billion over the last year is research and development and selling and administrative costs really haven't changed. And I certainly haven't noticed any drop off in innovation by not adding more to the research and development from Tesla. Now, Tesla says they break themselves down into two segments, but the way they report this, they have this other category, services and other. This segment is made up of their vehicle repairs, used vehicle sales, insurance, and sales from some of their other subsidiaries. We can really see here just how much bigger the automotive segment is than the energy business. Energy and storage hasn't shown much growth over the past 3 to 4 years. To me, Tesla's business seems to rely on Elon Musk's vision for what it will become. It seems like Musk has been very focused on the automotive portion, and the energy business hasn't gotten as much attention. Now, this is just my opinion, but I wonder if the energy business stays flat until Elon turns his focus back to it. Okay, so let's take a look at the valuation. But before I do that, if you could take a second to scroll down and hit the thumbs up button, I would really appreciate it. I try to make these videos as helpful as possible to understanding what's going on with the business, so if you could help me out with a quick thumbs up, I would really appreciate it. Now, going back to the revenue, operating income, and net income, and including the full 2020 through 2022 forecast, we can see that growth is forecasted to continue with profits estimated to break $6 billion in 2022. I think this makes sense when we consider the cost of revenue has maintained 81% and the rest of their costs have remained consistent. As they continue to sell more cars, I don't see any reason why they wouldn't continue to grow profits at a similar rate. Now, looking at the historical growth rate for Tesla, we can see that 2018 to 2019 was the worst year at only 14% growth. But they've since rebounded and are on track for 27% growth from 2019 to 2020. The current forecast for the next 2 years are 47% and 27%. The balance sheet shows $46 billion in assets to $28 billion in liabilities. This gives us $16 billion in equity. They reported $13 billion in debt, so this gives us a debt to equity of 0.85. For all of those major factories they built and the high cost to produce the goods that they make, this is a very reasonable debt to equity ratio. They also reported $14 billion in cash. Now, I think a reasonable growth rate for Tesla's valuation is somewhere between 25% and 30%. So at a growth rate of 25%, it comes out to a PE of 85. And the growth rate of 30% comes out to a fair PE of 126. In the 2020 trailing 12 months, Tesla earned 52 cents per share. So this starts us off with a valuation of $44 to $65. When we account for the last quarter earnings of 2020 that hasn't been reported yet, they're supposed to end up with $2.34 for the full year. This brings a valuation up to $198 to $294 per share. Now looking ahead to 2021, the current forecast is for $4 per share. So this comes out to a fair value of $340 to $504. Now this is a long way out, but analysts for 2022 currently think Tesla will end up earning $6.77. If this is true, this would mean a forward valuation of $575 to $853, finally getting above the current share price. So if we look at this on a chart, we can see how Tesla is currently on track to be at fair value between 2022 and 2023. There are a lot of people out there who talk about the current earnings per share of 52 cents per share and the 1,000 plus PE ratio and claim that this is way overvalued. But I actually think that the price is very fair right now. This company really highlights why trailing earnings can be a lot less valuable than the forward earnings. But we do have to remember that these are always forecasts, so we shouldn't get too carried away being willing to pay for something that may take a very long time to actually be able to justify the price. So based on the current forecast, if you were to buy at the current price, I think you could reasonably expect about 84 to 172% return by 2026. Again, I want to stress that this is based off of the current forecast and no way a guarantee. Now, I do own shares of Tesla right now, and I do plan to hold them for a very long time. I think that they have some very serious major advantage, not only in their advanced battery technology, but also in their overall production model. Now, if you found this video helpful and you like this kind of content, make sure you subscribe and hit the bell notification so you know whenever I upload a new video. And as always, thanks for watching.